A splendid evening it is to viewers. Welcome to Equity News and Equity Access, your aerial perspective of stock market developments and of developments in the Zimbabwean economy. Thank you for joining us as we broadcast live from AFSUN Studios in Harare. I'm Ibn Mabunda. Let's get started. African Sun says it will continue to earn foreign currency from incoming tourists, as that has been allowed for in statutory instrument 142, which reintroduced the Zimbabwean dollar. The group expressed concern, however, tourists discomforted at having to convert their forex into local currency for general purchases, as foreign currencies are no longer legal tender. The group has completed refurbishment of the Harare and Mutare Holiday Inn facilities and has expanded capacity at Great Zimbabwe as well as the Wange campsites. Further refurbishment is set to take place at key hotels over the next 2 years. We engaged the group managing director at Shangwe. Let's have a look.
Let me start with GSAs. GSAs, those are general sales agents, which a company like ours or any other tourist entity in Zimbabwe will go to their source markets to sell your products on your behalf. You've got source markets like America, you've got source markets like Europe, you've got source markets like UK, Australia, New Zealand, Canada, Brazil, South America, and all those are key source markets which supply arrivals into Southern Africa and Africa at large. Botswana as a destination is doing very well, particularly the Joburg market. We believe that we've got the same competitive advantage in Zimbabwe. Wange Safari Lodge has got 100 rooms. We believe that we also have enough game to compete head-on with what you can see in Chobe, which is close to Kasane. So we believe that once we establish and refurbish Wange Safari Lodge, we should be able to compete favorably. In its heydays, when the product was still good, Wange business mix was 90% foreign, 10% local. And we believe that business, there's an opportunity for us to get that business from other surrounding destinations. We are not only looking at Botswana, we're also looking at Kenya. Kenya also is quite high in terms of safari experience. So you look at Botswana, it's mainly safari experience and also some of the MICE conferences. So we believe that once we finish the refurbishment at Wange Safari Lodge, we'll be able to compete favorably with our neighbors.
Fantastic.
Yeah.
Now let's talk about your ICT developments that you made reference to earlier.
Yeah. Our sales and marketing department has been renamed. It's now called Sales, Marketing and Innovation. The reason why we put innovation there is to try and encompass all the other developments, the world trends which are happening. One of the things we want to do and encourage is obviously our customers to book online. And we are working with various suppliers like SiteMinder and all the other things. We'd like to make sure that we make it easier either for a foreigner, for a person coming from the region, even for our local Zimbabweans to book online and pay online and make sure that when you get to the hotel, everything is sorted and is done. The statutory instrument, I say 142 of 2019, we're still assessing as to what will be the impact to the ordinary customer on the street and also to our leisure market or even to our conferencing business. The foreigners will continue to pay in foreign currency. If you're a foreigner and if you produce your passport on check-in, which is a requirement for insurance purposes and also for your safety, you need to produce your identity. Your identity determines whether you're a Zimbabwean or you're a foreigner, and you are charged accordingly. So as far as that is concerned, I think as our chairman alluded to, there is no change in terms of the foreigners. Yes, they will struggle if they were to wander around in the city and want to buy something from the shop. They've got a foreign credit card and the little shop hasn't got a foreign credit card machine. Obviously, they will have problems.
Okay. Yeah. African Sun also reported 131% growth in revenue to 48.5 million Zimbabwean dollars. 56% of that revenue was in local currency, while 44% was in forex. Occupancy over the first 5 months was down 10% to 43% against 53% reported in the comparative period last year. This was mainly due to the violent protests that broke out in the country in January of 2019. Notably, the group paid dividend of $3.3 million, with 52% of that having been paid in forex. Now let's just have a quick look at the historical performance of the group over the past 5 years. Negative performance in 2014 and 2015. 2016, there we see a growth in profit after tax to $4.9 million. 2017, $4.8 million in PAT, while 2018 reported $10.1 million in profit after tax. Revenue also growing from $43.6 million in 2016, moving right up to $68.5 million in 2018. As we make progress, listed hospitality concern Dawn Properties has expressed optimism in their hospitality business despite harsh macroeconomic conditions. The group is looking to construct additional rooms in Victoria Falls right next to Elephant Hills Hotel, where the group acquired 3.5 hectares of land. At the same time, there are prospects of the construction of what is known as the Kachana Tented Camp Lodge in the Wange area. We engaged the managing director, Mr. Matute, at the sidelines of an AGM held in the capital this morning. Let's have a look.
We bought 3.7 hectares last year from the Vic Falls municipality, and the land is actually just next to where the Elephant Hills is. So if you combine the two pieces, we resultantly have 14 hectares. So Ellie Hill sits on 11 hectares, and then we bought another additional 3.7. So we have in total 14 hectares. So what we want to do is to see if we can create another hotel within the same complex, but obviously design it in a way that, the two hotels can speak to each other but not compete with each other, look for different markets or play in different markets. So we've got additional piece of land which we're now planning internally in terms of how to increase the number of rooms that we have on our portfolio in Vic Falls. In Wange, we've always held on our books 2,300 hectares, piece of land called Farm 41. I think back in the 90s there was a lodge there called Kachana Lodge, which used to be operated by a company called Touch the Wild in partnership with African Sun or Zimsan back in the days, and then I think it was closed early 2000. So we've always kept the land. It's actually next to Wange National Park, and because of land in the national parks, it doesn't have boundaries, so even the big 5 rooms on our piece of land as well. So we're thinking of putting up a 5-star tented camp there. I think evidence on the ground since 2017 shows quite clearly, even after the airport was put, there's huge international interest in Vic Falls and in Wange. So we just need to increase or up our game and play in the 5-star market both in Vic Falls and Wange. So there's still a big market. So I think I'm not worried about what other products people are bringing. I think it just makes for a healthier competition and makes for shared marketing costs all over the world in terms of the destination. And if you actually go, let's say for example, if you go to Kenya and you go to the safari in Kenya, sometimes as if you're driving, it's like there's a traffic jam in the wild. Okay. You see a lot of combis lining up. You go to Wange, there's nothing like that. So your 5-star market actually sometimes like that because it's not too crowded. So I believe there's still a lot of opportunity which people I think should really seriously not be bothered that a lot of rooms are coming. The potential is still there. Airlines keep signing up at the Vic Falls airport. That's why players will tell you we've run out of rooms.
Your property your land development projects, what can we expect where that is concerned? You mentioned the Marlborough.
I think we're focusing in terms of residential, I think on one project at the moment, the residential development project in Marlborough, 374 stands in total. I think we will likely phase it. We'll start this July with Masimba. We will likely phase it, hopefully deliver 64 stands in the next 3 or 4 months, and then we'll see with the uptake, how we can accelerate that. But the good thing is the sunk cost already, the land is on our balance sheet. We're not looking for land to develop, so that makes us very comfortable in terms of pacing ourselves the way we want.
Well, thank you, Mr. Matute, and good luck.
Thank you very much.
Viewers. Now, in a trading update, the group reported an 85% growth in revenue to 4 million Zimbabwean dollars in the first 5 months of 2019. This was mainly driven by growth in rental incomes by 125%. Profit before tax grew 130% over the first 5 months of the year. Now, just to get into the historical perspective of how the corporation has performed over the past 5 years, moving right from the full year of 2014 right up until 2018, the end of year. Now, in 2014, they reported revenue of $5 million. 2015 dipping to 5.17, 2016 dipping again to 4.35. Ever since, there's been an upward trajectory in terms of the trend, as you can see from the chart there. 2016 profit after tax of $1.02 million, 2017 tripling that to 3.05 million, while 2018 reported $3.52 million. Revenue, of course, getting up to $11.16 million. As we make progress, listed logistics concern UNIFREIGHT reported a 21% growth in revenue in the first 5 months of 2019. The growth is due to 20% increase in tonnage volumes. UNIFREIGHT also reported exchange rate gains on acquisition of property worth of equipment worth over $3 million, which was financed by debt. UNIFREIGHT has expressed optimism despite economic headwinds. This was expressed during a trading update issued at an AGM held in the capital this morning. Our Equity Access team was on the ground. Let's listen.
Of RTG versus the US dollars, and now US dollars being taken away completely with the latest statutory instrument and its corresponding increases in fuel and spare prices, have in turn pushed up our own rates but contributed to an over 100% increase in revenue. One of our main challenges going forward will be the replacement of equipment, spares and fuel, which are all important, and being able to keep our rates viable enough for our own customers to stay in business. However, the biggest challenge I think we're going to face is staying calm and determined to chart a course through the current chaos, which we've always been able to do in the past. If you forgive me for getting a little bit philosophical and nostalgic, with a couple of quotes I used in 2016 in commenting on outlook and our strategy going forward. The oldest and strongest emotion of mankind is fear, and the oldest and strongest kind of fear is fear of the unknown, which is from H.P. Lovecraft. And I think that's the biggest place we're sitting in the moment, is we don't know what's going to come next. But there's a rejoinder to this quote from one of my favorites, Ralph Waldo Emerson. He says, "When a resolute young fellow steps up to the great bully, the world, and takes him boldly by the beard, he is often surprised to find it comes off in his hand, and that it was only tied on to scare away the timid adventurers." There's so many variables at play in Zimbabwe at the moment that no one knows what's going to happen next. But at UNIFREIGHT, we've taken the decision not to let the fear of the unknown paralyze us into inaction.
Now, gold deliveries for the month of May came in at 2.2 tons, up from 2.1 tons reported in the month of April. Notably, however, is that over the 5 months period, deliveries came in at 10.8 tons, which is down 20% on last year's performance. New policy measures are likely to have a significant impact on production. Currency stability will determine the trend going forward. Now, gold is Zimbabwe's largest forex earner, raking in $1.2 billion in 2018. Gold deliveries for the year 2018 came in at 33.2 tons. Now, government has set a target of 40 tons for the year 2019, but as it stands, our deliveries are 20% below what we performed last year. It remains to be seen whether we will live up to the expectations of the targets set by government. This concludes our evening news bulletin. Up next is a look at the news under News Review. Don't go anywhere. Welcome back, viewers. It's time for news review, and with me to discuss the news that we just reported is Chief Analyst Respect Gwenzi. Respect, good evening and welcome to the show.
It's always my pleasure, Eben. Good evening to you too.
Fantastic, thank you. Now let's get the ball rolling. African Sun says that, look, in light of the statutory instrument 142, our forex revenues are really not affected as forex as tourists that actually come into the country. All they have to do is produce their foreign passport, and then they can be allowed to actually make payments in foreign currency. What is your comment of that particular development in light of what just transpired?
Yeah, so I mean, the CEO was very right to point out those developments in the company. But I think more critically, African Sun has been performing well, but this has mainly been driven by a surging foreign business. That's for the previous year. But getting into 2019, the dynamics have now changed. We are seeing a business that is now having to suffer a bit of a lag in terms of local on the local market due to changes in the monetary system and so forth. So obviously demand from the local market is going to come down. But in such a situation, I mean, given what's happening as well, the forex business has been booming. Last year they earned, I think, about more than 13 million, which is about 30% of their income from foreign business. And they are saying that given the new rules, they are likely to continue to grow on the foreign side. And they are the predominant players in the hospitality entity. They hold most of, the significant portion of market share in Victoria Falls. So I think they are set. They're quite diversified from some of these dynamics that are taking place in Zimbabwe because of the foreign component of their business.
Now, of course, tomorrow, viewers, we will elaborate on these financials in the afternoon. But now, just also in the same vein, Dawn Properties, they also held an annual general meeting. They also gave a trading update, and according to a conversation with the managing director, Mr. Matuta, he did indicate how that they're looking to construct additional rooms in Victoria Falls, right next to Elephant Hills, 3.5 hectares of land right there, as well as prospects of the construction of a tented camp lodge in the Wange area. How important are these developments to the progression of both Dawn Properties as well as African Sun?
So they are definitely a market leader in that space, in the hospitality space, in terms of hospitality properties. I think the times are favoring them. They've managed to rake in from the surge in tourism business in 2018. Coming from a good performance by African Sun, which is their key tenant. So they are a market leader, and they are making moves to solidify that market position in the respective markets, resort markets of Victoria Falls and Wange. And all these movements towards expanding the portfolio within that region, it shows that it's a company which wants to protect its turf. And I think that has been one of my concerns, to say there are a lot of players who are coming into that space. But at the same time, there's been growing demand, and there's been a lack of supply in terms of enough rooms. And so a move to try to expand in that market by by having more rooms, increasing rooms in Victoria Falls, as well as having some operations within the Wange area as well, which is very close to Victoria Falls. I think that movement solidifies the turf within the resort space. And also, I think they have got other plans that they are rolling out, trying to diversify the portfolio from a predominantly hotel focused to getting into residential and some other sectors, which I believe is also a good way of diversifying their portfolio. So I think they're making the right moves to solidify their position as a market leader in the hospitality space.
I realize. Now, lastly, gold deliveries for the month of May coming in at 2.2 tons, a slight increase from 2.1. However, over the five-month period, we are 20% below last year's performance. Your comment where that is concerned?
So gold is one of the key commodities, produced by Zimbabwe. It rakes in about 1.2 billion per annum in terms of export receipts. And that accounts for about 30% in terms of the net export receipts that Zimbabwe receives. So as a commodity, it's the single largest commodity, or the single largest driver of this economy, if I may say. So its production or its deliveries and its price are of key note to Zimbabwe. Why? Because if production goes down, it automatically means that your earnings in terms of export receipts is also going to come down. And when export receipts decline, that also means your forex in the market becomes even lower. And when that happens, it means supply on the market, now that we are in a liberalized market, will also be low, and there will be therefore a lot of exposure on the RTGS side. And given that we now have got monetary flexibility to print and to do what not, it means the local currency will become even more vulnerable under such circumstances where export receipts are falling. So gold, I mean, as a product, it's quite significant to Zimbabwe. And looking at the trends, the 5 months trend is showing a 20% decline on last year. That's about 10.8 compared to about 13.5 tons. And our target, we are targeting about 40 tons this year. And yet on 5 months, we are barely 11 tons, if I may say. And that means if we are to use that scale, it means by year end we would barely gone over 25 tons thereabout, which is even below last year's levels at this current production rate. But what is going to play out from now? In Q4 2018, we saw a sharp reduction in volumes.
Yes, in the deliveries,
yes, from an average of about 3.6 tons a month to roughly just about 1.1 thereabout a month, which was quite a huge steep decline. And government had to intervene. At that point, inflation was high, the currency was losing value, and RBZ was offering just lower retention levels, and therefore they increased the retention levels for miners. But that was the biggest causative for a decline in production. So this was obviously currency related, inflation related as well. And so after government had introduced measures to try to increase the retention levels, that's when we started to see a rebound in terms of production. If you look back a bit again in 2008, where we realized the list volumes in the whole year of just about 3 tons over the full year, that was at the peak of the inflationary period where the currency was losing value. So there's now this trend where you're seeing production of gold or deliveries of gold becoming highly elastic to the currency. They respond at a very significant rate to dynamics within the currency sector of the economy. Therefore, going forward, if we are saying we have now adopted a local currency, which already is now heavily it has now lost significant value to the US dollar, and therefore there is less hope within the populace that this currency might still hold fort. And what does it mean then? It means that the projection is likely that maybe this currency might keep on tumbling. And if there is that projection, and miners are also generally of that view, it means as we go forward, they are also likely to retain the same trend in the periods where they were reducing production against a decline in the value of the currency or inflationary growth. So this is the biggest fear that we now have under the new statutory instrument 142 of 2019, where a government has bound the multi-currency system. Of course, the retention levels have been retained, but now if you want to utilize your what you would have earned from your sales, it means you have to either sell at interbank levels, which means eventually you have to hold RTGS dollars, and that's a currency which, if I may say, is believed to be weaker. So I think this whole dynamic may push miners back a bit, such that they will start to produce less and obviously protect because it's a mineral on the ground, and they can simply preserve the value of their mineral by just leaving it there, I mean, on the ground. So this is one danger as we move forward, is that projection is quite likely for big scale miners, the primary producers. Yes, the biggest challenge there is about electricity. In the last quarter, in the last quarter to the first quarter of 2017, last quarter to 2018, during that rainy season, there was a serious erratic power supply issues, and volumes came off. I remember very well Rios reporting some sharp declines in production, and therefore electricity is critical for large-scale miners. So if those are deprived, given the current rates of power outages, if they are deprived of power, it means their productive capacity is stifled. It means what they can produce at a given time is also reduced, and it means they have to seek alternative power, or they have to abruptly stop production. So all that feeds into what we'll end up calling the national produce, or the expected receipts from export sales. And so my projection is that there might be chaos in that market. The only way to sustain good production rates is when we can have a stable currency which everyone believes in. And to have a stable currency, it means there have to be increased confidence levels, and they have to be obviously sorting out the macro fundamental issues that I believe are significantly outstanding and are not in shape at the present moment.
I realize. Well, thank you, Respect, for the perspectives. Thank you, Via, for staying with us. Up next is a look at the stock markets in Markets Daily. Please stay tuned.
Good evening, ladies and gentlemen. Welcome to Markets Daily on Equity Access. My name is Anis Chumbumu, and joining me today is Respect Kwenzi, our chief analyst. Respect, how are you doing today?
I'm doing just good, and you, Anis?
I'm all right. Now, the stock market has now continued on a free fall of sorts for week-to-date levels to come off to about negative 5.41, negative 6.4 for the top 10 index. Now, this is consequent to a 4.16% drop today on a day-on-day basis for that for the top 10 index is set at 203.61 points. The industrials index did come off 3.4%, while the all-share index led up 3.38% since the introduction, or rather, the introduction of the new currency and new currency in quotes and the ban of multi-currency regime. Now, we do realize that there are pretty much some significant drops in Econet, Cassava, Citco International Limited also coming off, Old Mutual also coming off. Those two could also be much a reason to do with the 90-day vesting period that has been pretty much instituted into the law now, causing for those drops. Where do you think the market is going to go? Let's say maybe 2 weeks from now, would we see the market coming back up, or it would have come down to a normal level? Would year-to-date gains be totally eroded from this new development?
So the market is still digesting the dynamics around the new currency, but clearly the board is turning red. Week-to-date gains have now been reversed. If you also look at the month-to-date gains, the board is slowly turning red. But then among the heavies, there has been a bit of carnage there. Major stocks coming off, and that's mainly Econet, Delta, Cassava. On a week to date, Delta is really down by almost the same margin as Econet. So that really shows you the direction the market is now turning. But then there's pessimism, but it's cautious pessimism.
Okay.
Obviously, people are believing that there might be a temporary stabilization, but then it might not be sustainable. Why? Because I think these gains could have been more drastic had the broader market been believing that we are actually getting into the better side of the currency, or a better outturn given the new rules. So I think there's still that part of the market which still believes that there might be, there might be a sustained, the market will re-rate sooner. There's still also the part, others who still who are still on the edge. They're still trying to dissect what this means. And of course, there are those who have already panicked, and maybe they are quite sure of the corrections or the direction, the good direction the market is taking. Because going down actually means good for the currency itself. So my own take would be that they might be, government will try everything in its state to try to stabilize the currency. But from a private sector perspective, there is not yet an appreciation of that dynamic. Business was also caught unaware, but sometimes if you are sitting in that position as a board that's possibly representing business, sometimes you are forced to move along with what government demands, basically because you want to protect your turf. You know that there's been damage, but you want to do a damage control kind of situation. Why? Because if you don't do that, then there might be a sharp erosion in value. We have seen the CZI, not CZI per se, but what we call the Economists Roundtable, which is characterized by characters from previous CZI and also some economists in town, some who are government inclined and so forth. And these have been trying to firefight. And this is the same group which came out and said the 2% tax is necessary and so forth. So there are quite some different narratives, but I think from a pure business perspective, these policies, they came at a time when no one was expecting, and therefore they're bound to bring in that shock. And they also came at a time when the exchange rate against the local currency was actually adverse. Therefore, it implied that there was a real weakness in the real value of the underlying currency. So business is not as optimistic. They, in their position, they can't go all out like a trade union to say this thing is completely not in shape. They have to salvage whatever little is there, because they've got the money, they've got the skin in the game. So they have to somehow cushion or to try to minimize the damage. Okay. So this is the view that I'm reading from the market. So I think we are not yet at a position where we can really be firm to say that these measures will drive the currency in the right direction, and therefore the market as well will keep on maybe falling. I think at this point, these are just immediate shocks which are not really fundamentally informed. I think these are just basic reactions which happens to markets whenever there is a key or a major policy that comes into effect. But to really determine the direction where the market is taking, I believe it will take some time to decipher the true outcomes and so forth.
All right, on our 5-day trends, 5.41 for both the industrials index down, while the top 10 index is now down 6.49 from 217.73 points last week to 203.61 today. Mining's index is down 4.13. Now, in pretty much what has become a seller's market since yesterday, we did consolidate about 14 laggards versus 4 risers. Total counters that it did exchange hands did come off from 34 yesterday, and 29 did trade today. Now, it seems as if the bears are back in town, and Exia
Sure.
is down 14.02%, settling at 55 cents, pretty much extending on its prior session losses. Econet still on a sideways mission there, where it hasn't been very consistent as to which direction it is really taking. African Sun down 7.17%. Now, African Sun did have an AGM today. They did mention that their occupancies have been coming off, but revenues have pretty much stayed firm. Now, it was going to be pretty much expected, in my view, because of how last year's business was pretty much a peak season for them from January through to December, because of how the climate was set in that particular time. Now, for this 5 months there, they did lament much to do with the Q1 mishaps that did cause for a decline in terms of goodwill for the country, that has pretty much drawn back a lot some foreign business that has come off. But they did mention that they're really looking into getting into new markets, one of which they did mention was India, and Ed Shangwa did mention that they have now come to a place where they're putting in agents, which they would call SGAs. I'm not very familiar with the full meaning. SGA. So those SGAs are looking to really penetrate onto what's happening on the market in those regions, and try and probably drive up their earnings. Willdale did also enjoy a pretty good half-year set of results. Revenues were up. I'd suggest much to do with the inflationary pressures coming in there. Cassava down 5.96. On the other end of the yardstick, ZB Financial Holdings, which are set to have an AGM tomorrow, shot up 10% to 55 cents. Edgar's up 9.09%, while Insco and Delta, which were the only two of the top 10 counters to come up, kept that set of fallers and risers. Now, for the Forex market, yesterday there were some pretty sharp declines on both the parallel market and the old mutual implied rate. Now, old mutual implied rate has much to do with the 90-day vesting issue that has caused for that drop. Also bringing into factor the whole new currency system that has caused for the market to.
Yes, so I think this is quite some interesting dynamics we're seeing playing out broadly in the FX market. The old mutual implied rate, the 90-day vesting period, actually says an investor who buys on the ZSC has to hold on to their shares for 90 days. Previously, you could just buy once you're cleared, then you can move your shares to SA and you would dispose, get some money, come back in, and you try to profit here from that. So that was really pushing the price. And besides pushing the price, which is not a big deal anyway, shares should go up. But I think the big deal there was the kind of arbitrage that was being created in the market due to the multi-currency system as well as to that lag. But I think, of course, normal markets would want to have that characteristic of fungibility. But that's what has caused that sharp knock. If you look at the share price of Old Mutual and also PPC, which are both listed in Zimbabwe as well as in South Africa, but primarily in South Africa, they've really been among those weakest counters, and the counters that have fallen over the past 3 sessions, which is which shows the immediate impact of the new policy measures on the stock market. But if we are to then look at how the parallel market is played, that's just a sharp plunge. But I think we are now beginning to also see an emerging trend again. I think that's inspired more by what's playing out on the interbank market. Rates of 6.54 officially. I mean, that shows you there's still not as much liquidity on that market, and that's really a worrying trend. Why? Because what would drive the parallel market lower is because there's now an appreciation that much of the supply or much of the demand was coming from people who were failing to access funds via the interbank market, and therefore they will now be satisfied on the formal market at a lower rate. So we have to come down a bit and narrow the margin. But now it's not as we expect. We are now beginning to see again an emerging trend. We wait to see how that plays out, maybe by weekend, to see whether there's real growth in terms of that price.
I think I agree with you. Just as we close off, I did speak to a couple of colleagues in the marketplace. They did mention that even within the corporates, they haven't really started playing much on that interbank market since the Monday incident. Now, I think that did cause for a small plunge on Tuesday, but then now for the interbank rate, it did come up more usually than it does. It did weaken by about 2% today to 6.54 from the 6.32 that it was trading in the prior sessions. I think that little plunge also had much to do with no trades.
But what
really
do you do when you've got a 30-day moratorium to seed your forex earnings? What do you do as a business? Of course, it doesn't inspire confidence, but I'm thinking that industry is obviously retaliating in a way. They don't agree with the aspect of having to be pushed to liquidate your earnings in a very short space of time. I think that's one of the contentious points within this whole currency issue. And of course, also the idea that government, as represented by the RBZ, is soliciting for funds to liquidate the interbank. I think that's also something that I don't get. Why? Because the market should be self-sustaining. How many facilities have you secured since 2016 to stabilize the FX market, or in fact the trade, outside trade? Those facilities, the immediate one is 500. Last year we got something of that sort, and so forth and so on. So they're obviously upwards of $1.5 billion in USD terms. And now they're looking for another facility in in China. What does that even mean? It means accruing interest, accruing debt, and obviously to support all that debt level, it means you have to at some point churn in local money, and that local money is inflationary. So I think government doesn't feel that there is capacity within the local market to push the interbank rate. In fact, they should rather be engaged in convincing the holders of money who are exporters and I mean, to inquire what they really want in order for them to be playing on the interbank market. If they don't sort that out, it's just a temporary measure. It's just a temporary measure that they're putting in place. One way or the other, we're going back to where we were.
Any more words would spoil this. That's it from me, Respect, and the Equity Access team. Don't forget to like, follow, subscribe our YouTube, Twitter, and Facebook accounts at Equity Access. Do also visit our website, www.equityaccess.net. Good evening.